Hey, welcome back to XRP Future Finance. I'm glad you're here today because honestly, there's a lot happening in the market right now and we need to talk about it. It's June 24th. Bitcoin is struggling. A major DeFi protocol just came back from the dead after a nasty exploit, and Chainlink just quietly made one of the biggest moves we've seen from any crypto project in months. So grab your coffee, settle in, and let's get into it. All right, let's start with where the market actually stands right now, because the numbers today are telling a pretty honest story. Bitcoin is down about 0.5% over the last 24 hours and is still sitting below $63,000, unable to push back above that level despite multiple attempts. Ethereum is also down around 1%. Now, these aren't massive drops on paper, but when you zoom out and look at the overall mood, this isn't just a small pullback. It's a market that's running out of confidence fast. Sellers are in control right now, and buyers aren't showing up with enough force to change that. When BTC and ETH are both in the red at the same time, it usually sets the tone for the rest of the market, and today is no different. That said, not everything is underwater today. SUI is up 2%, and AVAX is up 3.5% over the last 24 hours, and in this environment, that actually stands out. When the two biggest assets in crypto are bleeding, and you've still got mid-caps pushing higher, that tells you there's still some selective appetite out there. Traders are rotating, looking for momentum wherever they can find it. Whether SUI and AVAX can hold these gains through the rest of the day is a different question. But for now, they're the ones keeping a little bit of green on the board and giving at least some market participants a decent day. Trading volume has nudged up from around $68 billion yesterday to about $76 billion today. That's not the kind of volume spike that gets people excited, but it does show that activity is picking up a little. Volume context matters here, though. Rising volume during a price drop isn't necessarily a good thing. It can mean more people are exiting positions, not fewer. We'll want to watch whether this volume increase leads to any kind of price stabilization or whether it just accelerates the selling. Either way, it's a data point worth keeping in your back pocket as the day develops. Now here's the number that really captures the mood right now. The Fear and Greed Index is sitting at 17 out of 100. Just a week ago it was holding between 20 and 25, which was already fearful territory, but dropping below 20 is a new level of anxiety for this market cycle. A reading of 17 means the average crypto investor right now is genuinely nervous about what comes next. Confidence has taken a hit. The optimism that was starting to build a few weeks back has faded, and you can see it clearly reflected in that number. People are watching their portfolios and not feeling great about what they're seeing. Here's the thing though, and this is worth saying plainly without overdoing it. Historically, extreme fear readings like this have sometimes lined up with decent buying opportunities for patient investors. That's not a guarantee, and it's definitely not financial advice, but there's a reason experienced market participants pay attention to sentiment extremes. When fear is widespread and priced in, the setup for a reversal can start to form quietly. Whether that's happening right now or whether there's more pain ahead is genuinely unknown. But if you're someone who thinks in terms of months and years rather than hours and days, a reading of 17 is the kind of data point you write down and revisit later. Okay, let's move to the DeFi story of the day because this one has been building for over 5 weeks now. THORChain is back. The decentralized cross-chain protocol officially announced on Tuesday that it has resumed full operations after being completely offline since mid-May. Transaction signing is live again, liquidity provider functions are restored, and swaps are working. For anyone who's been following this situation, this is a meaningful development. THORChain's downtime wasn't planned maintenance, it was the result of a real exploit, and getting back online has taken serious work behind the scenes. If you're not deeply familiar with what THORChain does, here's the short version. It's a decentralized exchange that lets you swap actual native assets across different blockchains. Real Bitcoin for real Ethereum, for example, without wrapping tokens or going through any centralized bridge. That's a capability that's harder to build than it sounds, and it's why the protocol has a genuine user base that actually depends on it. No custodians, no wrapped versions of your assets, no trusting a company in the middle. That's the value proposition, and it's one that a meaningful part of the DeFi community has built workflows around. 5 weeks without it has been a real inconvenience for those users. The shutdown traces back to May 15th, when on-chain investigator XBT and security firm PeckShield flagged suspicious activity on the protocol. The exploit hit across multiple chains. Bitcoin, Ethereum, BNB chain, and Base were all affected. The team confirmed that roughly $10.7 million was drained from one of THORChain's Asgard vaults during the incident. The other 5 vaults were not touched, which contained the damage somewhat, but an $11 million loss is still a serious event for any protocol, and not something you just patch overnight. The 5-week recovery period reflects how careful you have to be when you're bringing a decentralized protocol back online after a security breach. You can't just flip a switch and hope for the best. You need to audit what went wrong, fix the vulnerability, verify the fix independently, and rebuild enough trust that users and liquidity providers actually come back. The THORChain team communicated throughout the process, which matters in DeFi. The community can handle bad news better than it handles silence. Now the real question is, what comes next? Whether liquidity returns to pre-exploit levels, and whether the protocol can rebuild its reputation over the coming weeks. That's the part of the story we'll be watching. Now let's talk about the story that I think deserves more attention than it's getting today, because what Chainlink just announced with Project Pangea is genuinely one of the more significant institutional developments we've seen in crypto this year. Chainlink has joined a collaboration involving 47 banks, yes, 47, focused on using stablecoins to overhaul how cross-border payments work. This isn't a white paper. This isn't a press release about a vague future partnership. These are banking institutions making real infrastructure commitments, and Chainlink is right in the middle of it. The 2 banking groups involved are Kavalis, a European banking consortium, and Unica, South Korea's banking alliance. Combined, these organizations manage over $10 trillion in assets. That context matters because it tells you this isn't a fringe experiment. These are mainstream financial institutions with enormous balance sheets deciding that blockchain-based infrastructure deserves a seat at the table in how they move money internationally. And they're not just studying it, they're building with it. The specific problem Project Pangea is trying to solve is the settlement lag on international payments, particularly along the Europe to South Korea trade corridor, which sees over $150 billion in annual trade. Right now, a cross-border currency transaction on that corridor can take up to 2 full days to settle. Project Pangea wants to compress that down to near instant, using euro-denominated and Korean won-denominated stablecoins to settle transactions in real time. That's a practical, measurable improvement that saves banks money, reduces risk, and makes the entire system more responsive. It's not theoretical. It's an engineering problem with a clear target. The payment model underpinning this is called payment versus payment, or PVP, and it's worth understanding because it solves a specific problem that's existed in cross-border finance forever. When 2 currencies exchange across borders under the traditional system, one side sends first and the other side receives later. There's always a gap, and that gap creates settlement risk. PVP closes that gap by making both sides of the exchange happen simultaneously. You send, I send, we both receive at the same moment. No exposure window, no counterparty risk in between, and lower liquidity requirements for everyone involved. It's a cleaner, safer way to move money, and it requires the kind of smart contract infrastructure that blockchain can actually provide. What ties all of this together, and why Chainlink's involvement is so significant, is that Project Pangea isn't being built as a replacement for existing banking infrastructure. It's being built to work alongside SWIFT and ISO 20022, the standards that global banking already runs on. Chainlink is there specifically to handle the interoperability layer, connecting traditional financial systems to the blockchain rails that make real-time settlement possible. That's precisely the role Chainlink has positioned itself to play for years, and seeing it actually deployed at this scale, with this many institutions managing this volume of assets, is the kind of quiet validation that doesn't generate the same headlines as a Bitcoin price pump, but carries a lot more long-term weight. That's your market update for June 24th here on XRP Future Finance. Stay informed, think clearly, and we'll see you in the next one.